welcome everyone. This is our panel on the SEC final climate disclosure rule. It seems like many of us were in this room 2 years ago when the proposed rules first came out. So it's good to finally be here and see what the final rules look like. Before we dive into our program for today, and we have a number of topics to cover, I wanted to do a brief introduction of the speakers here today because we'll have different people jumping into different panels, and we're lucky enough to have a broad range of expertise on a number of topics here. I'm Sarah Morgan. I'm a partner at Vinson Elkins and the co-head of our capital markets and M&A group. And I also have the pleasure of serving as the co-head of our ESG task force with John Solorzano and Matt Dobbins. And part of my practice is advising on various ESG issues and risks, and many of the topics that we'll be diving into today. And then to my right, I have Matt Dobbins, who's a partner at V&E and the environmental group. And his expertise is in environmental transactional matters and complex regulatory counseling and ESG issues, including many of the GHG emissions and other topics we will be talking on today. And then John Solorzano is out of our Los Angeles office, and he really is one of our lead ESG lawyers, and he advises on ESG programs and strategies. And he has a unique perspective because he spent a decade in-house at Clorox, where he was the assistant corporate secretary and led their ESG program. So he brings a lot of direct in-house experience that I know is valuable to all of you guys. And then to my left, our friends from EY, I have Rodolfo Araujo, who leads EY's ESG strategy and investor engagement efforts and is based in DC. And he serves as a strategic advisor to corporate leaders and investors looking to develop their ESG initiatives. So we'll have a lot on that and shareholder perspectives from him today. And then Carrie Helm is a partner in EY's Western Region Financial Accounting Advisory Services based here in Houston. And she advises clients on ESG reporting regulation readiness. And then a later panel, we will have our former colleague and environmental expert, Maggie Peloso. She's currently the Senior Vice President of Chubb Group, their Global Climate Officer, and she's responsible for their climate-related strategies, including business and public policy initiatives, and is generally an expert in environmental and global climate issues. So it will be great to have her perspective on both the rules and just sort of the insurance perspective of this. And prior to joining Chubb, Maggie was at V&E for 13 years. And then our friend Jessica McDougall at Longacre, she's the chair of Longacre's corporate governance and shareholder engagement advisory practice, where she works across a range of situations, including proxy contests, mergers, and generally the implementation of governance and strategic and sustainability related best practices. We've been working with her on a number of ESG related shareholder proposals. And so what she'll be bringing today is that additional shareholder perspective on how institutional investors view this rule. And then last but not least, we'll have the litigators. Rebecca Fike is a partner in our Dallas office, and her practice focuses on SEC and SEC enforcement. She spent nearly 10 years as senior counsel in the SEC's Division of Enforcement. So she's going to bring the SEC enforcement perspective on how they might think about looking at these rules and disclosures around these rules. And then, as I'm sure you guys know, and we'll be talking about a lot, this rule has already been stayed by the Fifth Circuit. And there's a lot of gameplay and theory around that. And Corinne Snow, who's a counsel in our environmental group based in New York, and she has a lot of government experience, including in the as a chief of staff in the Environmental Resources Division in the U.S. Department of Justice, and James Dawson, who's based in our appellate group in D.C., who also has significant experience in appellate administrative law, statutory law, constitutional law, and energy law. Those two are going to pair up at the end to walk through all of the litigation challenges to the rule and how that might play out, which is, endless game theory at this point in time. So with those introductions, we will just dive right in because we have a fair amount of content for you guys. Okay, so starting with the key takeaways of the final rule, which I believe was over 800 pages all told, which took a little while to get through. As expected, the final rule deviates from the proposed rule. Certain of these changes were expected. I think we've heard a lot of rumors for the last year that in trying to make sure that this withstands litigation scrutiny. There was a lot of rumors that Scope 3 was going to be dropped, and that came to be true. What was perhaps less predicted is that Scope 1 and Scope 2 emissions would be required only for large accelerated filers and accelerated filers. And then we'll talk a lot about the introduction of the materiality requirements to many of the disclosure requirements here, including Scope 1 and Scope 2. And again, this was we ended up at V&E writing, I think, 25 comment letters, which is very unusual for any SEC rule that you see that many issuers want to write a letter on this. And one of the many main thrusts of the comment letters on this was just the significant departure that the proposed rules had from sort of the underpinnings of the core tenet of the SEC's disclosure rules, which is, disclose if it's material. And so it's not surprising to see materiality brought into many of these requirements, but it does present its own challenges, and we'll talk a little bit more about that. Longer phase-in compliance periods, not just sort of for the initial disclosure, but phasing of the disclosures overall, and in particular, giving people a lot more time on the assurances required around GHG emissions. Our friends at EY will talk about the paring back of the SX amendments. And then generally, the structure continues to mirror TCFD, which was the original design and the original impetus of the SEC was saying, well, many people already make disclosures compliant with TCFD, so this should make it easy for them. But obviously, there are notable differences, which will not make it necessarily easy and makes you need to be very, very fluent in both sets of disclosure requirements. And then, as I mentioned before, you can tell that many of the comment letters written for the proposed rules were a setup to what ultimately would be the litigation challenges to the rules. And, the lawsuits were ready because many of these were filed immediately after the rules were released. And the Fifth Circuit acted quickly and has already ordered an administrative stay of the rules. That means, until that litigation is resolved, the final rules are not in effect. We'll talk about that a little bit more. Unfortunately, that doesn't necessarily relieve you from needing to know and understand the final rules, because there's a myriad of different situations and how that could be resolved and how quickly that could be resolved.
And maybe, Sarah, just jump in with a quick comment, because I heard many times about this whole process, and it was 2 years, more than 20,000 comments that was sent to the SEC. And people are always asking, do we really need it? We have already companies making those disclosures voluntarily, so why do we need to involve the SEC and have some kind of mandatory requirements here into filings? And we did a survey recently with investors, and we basically asked them, what do you think about this? And the answer that we get is that 99% they were using ESG data, including climate, especially climate, in their investment decisions, but 76% of investors thought that companies were highly selective in the information that they were providing. So part of this approach on the SEC is to address that concern.
All right, and then we'll hear a little bit more about this in the litigation section, but what are the SEC's legal grounds for the final rules? What's their authority to do this? And so you see this sort of crafted with an eye towards litigation and the final rules that the commission may require disclosure of information that is necessary or appropriate in the public interest or for the protection of the investors. And there is another note there regarding the financial statement disclosures in SX. And I think it's interesting when you look at the way, and so every time an SEC rule is released, in almost every circumstances, particularly now that it's sort of a very split House. You have the rules released, and then you have the statements from Gensler and the Democrat commissioners in support of the rule, and then you have the dissenting statements from the Republican commissioners. And you can see sort of the perspectives on this rule and the infighting that must have happened and the setup to litigation. So I'm going to read a statement from Gensler and then a statement from Hester Pierce, who is the probably the most prominent dissenting commissioner. But Gensler said, these final rules build on past requirements by mandating material climate risk disclosures by public companies and in public offerings. These rules will provide investors with consistent, comparable, and decision-useful information and issuers with clear reporting requirements. Further, they will provide specificity on what companies must disclose, which will produce more useful information than what what investors see today. And then Hester Pierce, who's the dissenting commissioner, she always comes up with clever titles, and Green Regs and Spam was her title of this, said, this rule replaces our current principles-based regime with dozens of pages of prescriptive climate-related regulations. While the Commission has decorated the final rule with materiality ribbons, the rule embraces materiality in name only. The resulting flood of climate-related disclosures will overwhelm investors and not inform them. And so you can see here, obviously, there are very, very dissenting visions of whether the SEC has legal grounds to make these rules and whether they actually comply with sort of the Commission's mission here. And that's all going to play out. That's all going to play out real time in litigation, too. And then before I hand it over to Matt, though, I will say that the sort of the dissenting attitudes and the way that it's approached and that the way that the SEC has approached this rule, leading up to these final rules is also going to make it very challenging in some respects to make some of these decisions on materiality with respect to some of the proposed rules, which we'll talk about a little bit more as we go through.
Thanks, Sarah. So one thing we wanted to do was kind of explain how we got here, right? It's been a bit of a journey on climate disclosures as far as the various actions the Commission's taken over now a decade plus. So we started in 2010 with the release of the traditional climate change guidance, and that was very heavily focused, right, on our traditional materiality lens as far as we look through things. They did call out specific climate-related issues to discuss, but again, through materiality, to the extent there were international climate agreements, given that we didn't really have anything domestic driving climate regulation or climate control at the time. That's something that would have to be disclosed. Same with physical risks. But as we've evolved a little bit, both in the voluntary reporting space and now in the regulatory reporting space, everybody's moved away from the 2010 climate guidance. And in fact, when you look at climate change related disclosures in existing securities filings, right, you kind of see that they more or less have kind of taken on a boilerplate approach where everybody's talking generally about the Paris Agreement, what that might mean. Everybody's talking about specific EPA focused regulations on climate. And so through the evolution of everything, we've got the TCFD kind of releasing its annex in 2017 that explained how to do TCFD reporting, set the stage for kind of the modern approach to voluntary ESG reporting. And then in 2021, we saw the Commission start pressure testing everybody a little bit as you had this bifurcated world of voluntary disclosures talking about potential climate change impacts, and then very light regulatory disclosures in your securities filings, right? So these were the Dear CFO letters and Dear Registrant, letters that everybody got. One thing I wanted to point out here is that it's quite possible, depending on how the litigation turns out, that we may see kind of a resurgence of these comment letters going out. Really try, as registrants may say, well, there are materiality qualifiers in the final rule. I don't believe any of this is material. We've determined this is not material to our company. So we're not going to talk about it in our 10K. I think, again, if the SEC doesn't get smacked down too hard in the litigation, there's risk of these letters kind of coming back. Now, the one good news about it is, as Sarah well knows, because she responded to a lot of them, you really just had to explain a little bit. You had to show your homework a lot, and that got the Commission to back down. But with the final rule, there's no guarantee that it might be as straightforward, again, depending on how litigation plays out here.
Well, and I will say on that, when we did respond to those letters, for the most part, if you responded with a reasonable or well-reasoned, this is the reason why this is not material to us, there wasn't even like a challenge, not even sort of a second comment, explain more about this. I think given the specificity of this rule, you may see a little bit more questioning of that. But it's not just, with this rule, it's not just as Rebecca will talk about more later, it's not just the staff at Corp Fin issuing these comment letters that you have to deal with. You now have to deal with the people on the SEC enforcement side probably a little bit more heavily as well.
So I'm just going to give a quick overview. We already touched on materiality a little bit, and I think it's going to be a running theme throughout this discussion. There were some differences in what the proposed rule looked like and what the final rule has looked like. They've reintroduced concepts of materiality throughout, in particular, and we'll talk a little bit more about this with regard to material scope 1 and 2 emissions, which is kind of a head scratcher for a lot of folks. But laid out here on the slide are kind of the well-established concepts of materiality, looking at the Levinson and the Northway cases. I'm not going to get into those Supreme Court rulings, but just basically at a high level, it is the requirement to provide decision-useful information that a reasonable investor would want to know. And so that's what's really driving a lot of the disclosures, and that's kind of the rationale that the SEC has put forth in sort of marrying materiality to a lot of the various components of the final rule. So you're going to see that kind of throughout, and there's some differences between what the proposed rule looks like and what the final rule looks like, and you're going to see some materiality integrated into that. But it's still perhaps a little bit unclear once you start thinking about what is a reasonable investor here? How do I think about material climate-related risks, whether they're economic, whether which investor should I be thinking about over what time frame? All of those questions are going to be up for debate. And so I think that in some ways the SEC was certainly trying to survive court challenges and sort of tying it to its more traditional perspective on materiality, but in some ways it also introduced some new confusion. And so that's something that we're going to need to unpack a little bit.
And one thing that John and I was discussing yesterday that is relevant to this point about materiality is that honestly, climate change issues are going to be material for almost, if not everyone in the room. So every company in the market, and that's based on the discussion that I also had with some of my clients that are even low emitters, or not even about companies that have a significant amount of GHG emissions that they are responsible for. And the point is basically saying, if you think about reputational risk at this point for companies, if you think about also about regulations from California, regulations from Europe, that the intent is really not just disclosure, but they have an objective in terms of decreasing the amount of emissions over the long term. And you think about ask you two questions that are very basic in terms of, could this in any way impact my company financially? And the answer most of the time is yes, especially with the reputational risk. And you go to the second question that would be, would an investor care? So if it's impacting a company financial, every single investor are going to care. On top of these two things, we have the fact that investors are using this data to make decisions. And some of the capital in the market are being more and more kind of restricted from making significant investments with and having a portfolio with a high amount of emissions. If in a way this impacts the flows of capital, it immediately also becomes material for most companies, because it means that it's increased the cost of capital for high emitters or people that or companies that are not pursuing some kind of transition plan. But it's just pointing out that in the end, yeah, we're having discussion about materiality, but to play safe, I would say that probably almost everyone is going to be included here.
Yeah, I mean, I think that the design of the rules and some of the snippets from the adopting release of the final rule, it is sort of, saying implicitly, if this is something that is heavily regulated for your business, as it relates to climate risk, it's probably going to be material for you. And there's a few things in there. But I do think that some of these materiality determinations are going to be really challenging, and a company is going to be hard pressed to say, do I really want to say this is material for my company when we just don't think that, and we haven't designed our strategy around that. So I think there is going to be a lot of discussion, within management teams and boardrooms around these particular elements and what we do and don't disclose. And this is why, for those of you whose sustainability reports that we work on, there's a lot of information in there that's not material. So just because it's in your sustainability report does not mean that it should necessarily be reported with respect to these rules. And we typically would disclaim that in a sustainability report. Okay. And then a bit of good news on the final rule compliance deadlines. Again, this could all also be impacted by the litigation. I find this is the SEC's chart, but I find it to be very confusing. So when it says, in here, the fiscal year beginning 2025, what it really means is that the first date that anyone is going to have to report on this is in the first quarter of 2026, if you're, assuming you're a fiscal year end filer with respect to your fiscal year beginning 2025. And again, they've staged different categories of disclosures when the compliance deadlines are. And so what I'll call the soft SK disclosures and some of the SX disclosures, that is the earliest deadline is that, February, March 2026 for large accelerated filers with respect to 2025. And then you can see that it is phased in by category of registrant later date with respect to that disclosure type. And then further complicating the matrix, depending on what the disclosure is, there's further phase-ins for other disclosures that we'll talk about here, primarily related to the qualitative and quantitative disclosure of material expenditures incurred with respect to various climate-related things. And then even later is the phase-in of the GHG emissions in the various levels of assurance. And I will say, in almost every single SEC comment letter that we wrote on behalf of clients, it really was, there's just not enough time to gather this data. And by the way, these assurances that you want, the limited reasonable assurances, the people to do them doesn't exist. And they're not going to exist in the timeline that you've given for implementation here. And so it does seem like when they did look at that, they took that to heart. And so you see a more protracted timeline for implementation here on this. And one of the other comments that we frequently made was you were asking for GHG emissions data ahead of when we otherwise gather it and report it to other regulatory bodies, the EPA, or that we reported on our sustainability reporting cycle. And it is so much pressure on the system for you to lay this on top of on the 10K and other information cycle. And here, I think they did listen to that as well, because for GHG emissions and related assurances, you have the option of reporting that with your second quarter Q, which I imagine most people will take. And so you can see that the implementation deadlines for this is far more protracted than the original proposed rule. And again, I think that's being responsive to the comment letters and also probably designed a little bit to withstand litigation. Okay. Filed, not furnished. So this is a big deal. This is part of why they wanted to make this part of the SEC's rules. So it's filed. It's therefore subject to different liability standards than, say, your sustainability report. And this is deliberate. He said in the adopting release, in his adopting statement, Gensler said, requiring the disclosures to be filed promotes accuracy and consistency because to the extent that registrants are seeking to avoid liability, they are going to take additional care to ensure disclosures are accurate, which means he doesn't think a lot about whatever disclosure controls you guys have around your sustainability reports. But I think this is very deliberate, and they didn't, I know that there was a lot of requests in the comment letters. Could we put this in an addendum that's furnished? They didn't take the bait there. But as Matt will talk about in a little bit, they did at least pair it with an expansion of the PLSRA safe harbor.
And maybe to just bring an example here, and it's not even on things that were filed by the company. But if you think about the situation of Vale in the Brazilian mining company, the SEC went after them with a significant fine because of the issue that they have with the dam that killed a significant number of people in the country. One of the items that they point out for the fine is the sustainability reports that they had provided to investors. And on the sustainability report, they were saying that in their health and safety segment, they were saying that their operations were safe, and positioning specifically the dams that they were safe. And that was used basically to go after was the fine. So you can see that trend here in terms of ESG information coming also to the climate disclosures. And you have to realize that in addition to the KPIs that you're going to have to provide scopes 1 and 2, we're talking about some financial information. We're talking also about some strategy, governance. So all of this is going to put together, and you're sending a message to investors. You have to think about what the liability might face as a result of that.
Right. And again, these are in file documents that are subject to officer certifications. And so when you think about the typical layers of review and disclosure controls that people have around their 34 Act reports and the sub-certifications and certifications that you get for the officers to make that certification, all of this is out of necessity going to be brought under that umbrella. I will say most of our clients, in response to the proposed rule, to the extent that they didn't already have those internal controls around their sustainability disclosures, they implemented them and had something similar to that layer, the layer of review that they have on the 34 Act disclosures on the sustainability report. So hopefully that part, sort of the enhanced disclosure controls around these disclosures is not going to be that much of a rude awakening or require that much of a change in your controls. But I think there obviously is significant concerns that there's a heightened liability around these statements being filed not furnished.
So I'm glad Rodolfo brought up the Vale SA example, because many of you in this room, if you've ever had to look at V&E comments to your 10K, have probably seen us try to really scrub, we believe we are in compliance with, we are in compliance with, we are doing all these great things as far as regulations, and they're not going to be a problem with us. That kind of language, even if it's in the present tense, can be problematical. And there have been numerous securities actions from private plaintiffs over the years attacking statements like that. And that brings us to the forward-looking statements and the Private Securities Litigation Reform Act safe harbor. So one thing I want to say is a statement in the present tense could still be a forward-looking statement. Keep that in mind as you think about this. And to Sarah's point, the good news is the SEC did provide some protection here in the form of this safe harbor. Where it's really going to be useful, we've got it listed here. It's the future kind of targets, goals, potential impacts from scenario analysis, right? Traditional things that we would think of involve forward-looking projections and assumptions related to them. That's exactly what the PSRA is supposed to protect here. If you meet the qualifications, the requirements of the safe harbor, you don't have liability for a material omission or an untrue statement under either the 1933 Securities Act or the 1934 Exchange Act. So it's really important to make sure that your forward-looking statement disclaimer has been updated, adapted to deal with a lot of these climate-specific issues. John, Sarah, and I have worked with numerous companies, along with lots of other lawyers here at V&E over the past several years, to start making sure that voluntary reporting not only has these forward-looking statement disclaimers updated to focus on climate, but that we carry those through other different, various securities filings, other kind of earning release statements, because it's going to be really important as you try to shrink where liability could creep in as a result of these disclosures, that you try to maximize the value of this safe harbor. It's not perfect because, again, it only applies to the forward-looking statements, but it is a potential tool here to help mitigate potential liability risk.
Okay, and this is the components of the final rule. I'm not going to spend a lot of time on this because we're about to go into each component with granularity. But primarily this tracks the components that were in the proposed rule. It's just the actual content of each one has been pared back significantly in certain instances.
And maybe to jump in specific on the TCFD, I think that everybody realizes nowadays that TCFD became the gold standard, and not only in terms of just the way that you're managing climate risk, but also it has become the standard that has been adopted by different regulators in terms of how companies should disclose a variety of ESG data and risks that they're managing. For the disclosures, you have to think about, and that's what we're going to touch next, but you have to think that it's more than just KPIs. People talk a lot about scopes 1 and 2, and these are the numbers that you have to put on the reports. But we are really talking here about strategy, about governance, about the way that risk is identified and managed. So if you think about from the perspective of investors, they're basically asking you to provide how you are protecting value from investors with the strategy that you're following. There are many different ways that you can approach these questions, or different tools that you can use to manage the risk, but that's the question that is being asked there that you have to provide or not an answer. The second one is governance, basically understanding that there are people managing the risk. The risk change, the risk evolves. So you need to have that part of the presentation of to shareholders in terms of who and what process you have to manage current and emerging risks. And the third is really explaining how this process takes place at the company. But it's just to emphasize that it's more than just reporting on emissions. This TCFD framework really asks you how you are managing the risk to protect value to investors.
All right, just to get into the details a little bit, I'm going to try to go through this relatively quickly because there's a lot and we don't have a ton of time. So with regard to governance, and this is an area that's near and dear to my heart as a former assistant secretary working closely with the board, it's really important to be describing how the board of directors is overseeing these. And you know, this maps pretty closely with the TCFD, but the SEC took a slightly different approach here. I mentioned at the outset that they layered in materiality qualifiers kind of throughout. For the governance, for the board, they actually do not have a materiality qualification. They want you to describe which board committees are overseeing climate-related risks. They want to understand kind of how the flow of climate information is. Now, the second piece, which is 501B, talks about management, and management is materiality qualified. So they did introduce a materiality qualification there. So to the extent that your management team has identified material climate risks, they want to understand how that is being processed, who is involved in this. I mean, you don't need to name names, but you need to name sort of roles and responsibilities. And so that's a really critical component here is there's kind of the materiality threshold when we're talking about management, but there's not one when we're talking about board. They're sort of just taking this kind of kind of at face value. You need to describe what the board is doing, how the board is structured, what committees are overseeing climate risks. Whether or not you've determined those risks to be material to your business is not really relevant for the 501A component, but 501B, it is. And so that you just need to understand that there's a slight distinction between those two pieces.
And notably, they did at least back away from the requirement that you disclose the climate-related expertise of each director, which I think, caused a lot of consternation amongst people on, first of all, how you would do that, and also that they were directing that you had to have a director with climate-related expertise specifically.
Yeah, I might just also add around this topic, many companies are thinking about, if something needs to change necessarily and what within these rules, it's really around requiring disclosure. But part of that, when companies start thinking about, well, what do they have to disclose? In some cases, it is causing some reflection and reevaluation of the current structure and processes in this space.
Yeah, the SEC basically was saying, we're not trying to dictate how you manage these things. We want you to just disclose how you're doing it, if you're doing it. But I think, to your point, Carrie, this is going to change behaviors. Once you start disclosing, behaviors will change. And so that's kind of the inevitability of all of this.
All right, so I'm going to walk through these fairly quickly, but in terms of disclosing your strategy to managing climate-related risks, there's not really too much of a difference here from the proposed rule other than the materiality qualifier. We're still looking to the TCFD framework to kind of guide this strategy disclosure. It's still broken down into your physical transition or your climate-related risks and your transition-related risks. So into the physical bucket, what do we have? We've got your acute and your chronic physical-related risks. Think of acute as your severe weather events, your hurricanes, your floods, wildfires. When we're talking about chronic, that's longer term. Thinking about the effect of temperature changes on your operations, availability of water modeled over time, things like that. In the transition scenario, it's a little bit different. There you're looking for, are there regulatory, market, or technological kind of dynamics that are going to be driving impacts to your business? Again, you get to look at all this through the lens of materiality, supposedly. But a lot of companies that are already kind of leveraging the TCFD framework that have worked over the years to align with it, I think are going to be pretty well positioned to pull from existing disclosures. Doesn't mean you can just drop them in wholesale, but you may have a pretty good start on this particular issue.
Yeah, I would just add that we see quite a few companies already doing a climate risk assessment type analysis, either within the sustainability organization or as part of their overall enterprise risk management approach. And so I completely agree that we expect a lot of companies will be able to leverage those. It's really the trick is going to be around the interpretation of materiality and where do we draw that line for purposes of the disclosures.
Speaking of materiality and the interpretations around it, so the final rule retains the disclose it if you have it proposed rules with a layer of materiality over all of this. And so that's if your company has adopted a transition plan to manage a material transition risk, you have to disclose certain items with respect to that plan. If you've used a scenario analysis to assess climate-related risks that are reasonably likely to have a material impact, then you have to disclose certain items regarding the scenario analysis alongside the expected material impacts. And then if you've used internal carbon prices, which are material to how you evaluate and manage climate-related risk, you have to disclose information related to that. And so with these, I mean, my litigator colleagues can tell me if I'm wrong or not. To me, these are some of the most fraught materiality determinations that people are going to have to make. Because if you're, you know, if you think about this and you are a company that uses scenario analysis, you're looking at this and you say, oh, I'm not going to put this in here because I don't think it's going to have a material impact. And then a few years down the road, I mean, the only thing I know about scenario analysis is, you know, like they are all ultimately wrong. You know, they're useful as a tool, but not necessarily as a plan. So I think, you know, there's going to be so much work that has to be done around materiality judgments here, what disclosures are made, how they're made. Because again, you know, you need to be careful to, you know, if you're describing something as a material transition risk, well, what does that mean? Like that your company should be doing as a strategy around it. I think that there's going to be a lot of tension inherent in the disclosure pursuant to these rules that isn't necessarily there when you're just sort of describing things in your sustainability report, but not necessarily layering like a materiality analysis alongside it. I don't know if you guys have any thoughts there, but.
Yeah, I just also wanted to add, I've been part of a number of discussions around the term transition plan. And even though, you know, we have the definition here, you know, we've had many companies that are kind of trying to analyze the types of plans that they have. And does it actually, you know, meet that part of the definition? Or, you know, do they have other types of plans that would not even qualify?
You'll probably see a lot less use of the word plan going forward.
So on the risk management disclosure front, again, this is something that heavily borrows from TCFD. So if you've been consistently reporting under that, or again, working towards alignment on that, probably are going to be in good shape. But a few kind of key points that might make this a little bit tricky, right? And I would love for the EY team to weigh in on their thoughts too on any kind of controls they've worked on or feedback from their clients on this. But I think at some point, right, you need to talk about how you've assessed whether or not a risk is ultimately material. You've got to talk about your process here a little bit more. And that obviously creates some tension, right, because there's always room for disagreement on whether or not that's an adequate approach to risk management and strategy. So I don't know if we've got, you know, recent experience that might be helpful, or if there are concepts from similar existing requirements, or rather requirements that existed before this final rule in other areas that might be useful here.
Yeah, so I'm familiar with how companies are approaching this today, and would say at this point I haven't really seen kind of a formal, while there are processes in place, I haven't seen formalized process documentation or formalized controls in this area at all. So do think that, you know, that's a space that will likely require some focus in the coming years.
Because yeah, one thing I would encourage everybody to look out for is it's great if you stood up a number of committees. Are they actually, and working groups, are they actually talking to each other? And what's the documentation around that communication? That's something to keep an eye on to manage this requirement. All right, so our targets and goals, not too much else to say here. I mean, I think, again, how you approach your materiality assessment is going to be critical. And what might make some of the targets and goals material are how much of your business is exposed to a cap and trade regime or some kind of carbon tax regime. So companies where a lot of their customers or customers they are targeting for growth that might be in Europe, I think you're going to have to think really closely on whether or not a target or goal is material simply because of your growth strategy, right? And then another kind of trap that I think, at least personally, the commission might have looked in here is the carbon offset and REC requirement. So while you may have a materiality qualifier on your target and goal, this requirement here is not really disclose carbon offsets and RECs if they're a material component of a material target and goal. It's disclose them if they're a material component of a target and goal. So potentially this gets an end run around the materiality qualifier that's otherwise on a target and goal disclosure requirement. So what does that mean, right? If you have a net zero goal, scope 1 and 2 emission, and you've decided it's not material, but the only way you're going to meet that goal, or 50% or more, and there's not really a bright line here, we'd have to work that out, it'll be part of an analysis, right, is to think about, okay, are carbon offsets the only way I'm meeting that goal? If so, there's an argument you got to disclose the use of them. And as John will talk about later in another panel, what you have to say around offsets looks a lot like some of the California disclosure laws too. All right, on the GHG emission front, hopefully by now everybody's pretty familiar with scope 1 and 2 emissions. Scope 1, your direct emissions. Scope 2 are emissions resulting from electricity purchased for your operations or potentially process heat, things like that used in your operations. Key differences from the proposed rule versus the final is you only have to report carbon dioxide equivalent here. You don't have to disaggregate GHG emissions, which potentially lowers the burdens a bit. You still are leaning on the GHG protocol for this. Working with clients, you know, when they work on their emission inventories under a regulatory program, they come up with a different number of emission sources than they do if they do it under the GHG protocol. It's not always a huge delta, but that delta can exist. So companies that haven't really looked closely at how their emission inventory compares to a GHG protocol-based exercise are going to need to do that here to get ready to comply with the rule.
And maybe one quick thing that I should say about the 1 and 2 emissions and also scope 3 first. We have helped many clients sometimes redo their calculations. They were doing under GHG, they did it again. I saw numbers jumping by 50%. It's a filing now. You cannot have numbers jumping by 50% from one year to the other. So it has to be a lot more quality in terms of the work on scopes 1 and 2. Internal controls have to be in place. And second, think about this as minimum requirements. Investors are going to continue seeking information on scope 3. 1 and 2, it's very helpful for portfolio management. You can see the level of emissions of your entire portfolio. It's easy to work with that. Scope 3 is kind of useless because there's so much double counting that it's just used for company-specific analysis, but they still use it. And think about these requirements for 1 and 2 is going to help improve the quality of scope 3 information. So think about this really as minimum requirements and don't think that investors forgot about 3. It's still something that really they rely on for some of the investment decisions that they make.
Well, and we'll have a whole separate segment about other disclosure regimes and other disclosure rules. So even if you're not preparing scope 3 for the climate rules, you may be preparing it for a different disclosure regime, or you're preparing it, frankly, because your customers require it because they need to report it for various reasons, including other disclosure regimes.
And that's a perfect segue to this slide here. So I won't get into the difference between materiality, single materiality and double materiality, but just quickly, sort of single materiality is the impact of the world on your business, which is kind of historically how we think about materiality in the US. The EU takes a different view, not only the impact of sort of the outside forces on the company, but also the company's impact on outside world, whether that's society at large or the planet. That is a distinction as far as what is deemed material that I think is critical. And I think that's driving a lot of some of the regulations. And we'll get into this in another panel that we see in the EU. But what's really important to understand here is that we talk about how do you even determine what a scope 1 and 2 emission, how do I think about how that might be material to my business? There's some guidance within that monster of a rule that basically says it could be material if you're having to disclose it under another regime, then that's kind of step 1 in it being regulated, and there's a cap or a tax. Therefore, it might be material to you. So you might think rationally, this is just kind of an unpriced externality to my business. It's not material to my business. But this, as soon as I have to start disclosing this under California's rules or the EU's laws, I might have to sort of make the kind of chicken and the egg determination that has now become material because it's sort of the first step in it being regulated. It's a complex point, and it's one that I think is going to drive a lot of people crazy trying to understand at what point you make the determination that it's material or not.
Well, and I think that the tiered implementation dates are gonna have an effect here, right? So you have the large accelerated filers and accelerated filers going first, and if they all say, it's material, and again, a lot of them are disclosing it anyway. And so your entire industry group and peer set has a pattern of disclosing this. Once you get down the chain to the smaller reporters, they're going to be hard pressed to say, oh, look, 2/3 of my industry cohort say this is material, but it is not material for me. So I think there's a little bit of it's your peer group is going to impact some of this, and then the way that the disclosure timelines are implemented is going to impact some of this as well.
So the emission disclosure requirements are subject to different timelines for attestation. And again, I'll defer to our colleagues to kind of walk through what that attestation looks like, right? But depending on the kind of filer you are, these attestation requirements are going to kick in at different levels. And initially, this should not be a very difficult burden. And in fact, most of the companies we're working with are already kind of headed towards or have achieved the limited assurance piece. But maybe, Carrie or Rodolfo, you guys could talk a little bit more. What exactly is involved in obtaining limited assurance, and what's the uplift to reach the reasonable assurance requirement?
Yeah, so for limited assurance, the focus of the procedures is really based on inquiry and analytics. And in the first year, you don't have kind of that baseline year yet. So sometimes there is a bit more digging into the details and data, but leveraging on that in future years, it's really focused on inquiry and analytics. Once we move to reasonable assurance, that's the level that your financial statement audits are occurring at currently. Under reasonable assurance, you also have the auditor has an option for a substantive approach or a control-based approach. So for those companies that are beginning to put controls in place, the opportunity to leverage that is now starting in 2033. For Regulation SX, these are the disclosures that will be part of the financial statement footnotes. So they are getting a lot of focus and attention because it's a much different level of assurance that the auditor has to provide for this information. They're also going to be subject to internal controls as well. So that's a higher standard to get the processes and controls in place and ready for disclosure. The focus of these disclosures is around severe weather events and other natural conditions. You have to report expenditures as well as capitalized costs when they equal or exceed 1% of the absolute value of income or loss before income taxes. The good news here is that compared to the proposed rule, this is a much lower level of effort, lower level of disclosure. However, the materiality thresholds are still somewhat low, depending on the types of transactions that the company typically encounters.
Well, and isn't part of the problem that you now have to categorize these expenses just to,
Right.
it's like it doesn't matter because with a 1% threshold, you now have to go through the exercise just to conclude
And
that you're
track,
below
right.
1%. So it doesn't, like that the threshold isn't exactly meaningful or helpful. But yeah, it just introduces another sort of accounting exercise to already complicated financial statements.
Yeah, exactly.
Okay. Did you want to hit one of
Sure.
these?
Yeah, so I'll clarify a little bit on the emission piece. One thing, particularly with respect to the GHG protocol, right? Remember is that is the international standard. And one thing that the commission is stressing is comparability, right, between disclosures. So I do think there's still quite a bit of tension to drive registrants to disclose their emissions in accordance with the GHG protocol. And that exercise would require for scope 1 a comparison against any regulatory reporting you do to an environmental agency like the EPA or the California Air Resources Board, for example. And I will say that the GHG protocol still very much kind of controls your disclosure on your scope 2 emissions. But the one flexibility that you got out of the final rule as opposed to what was proposed is that you just have to choose one of the two methods for determining scope 2 emissions. You don't have to disclose under both. You just have to identify your methodology and disclose that so that everybody kind of has all the information at their fingertips.
And Matt's responding to one of the questions in the chat, and keep the questions coming, or if the live audience has questions, we definitely want them. We may not have time to get to all of them in the panel presentations because they are packed with content already, but to the extent that we don't, we will try and send you a follow-up email to address your questions. And so I think with that, we're going to take a very short break just to switch out to the next panel, which will be on interaction with other mandatory and voluntary reporting frameworks.
All right, well, in the interest of keeping things moving, we'll get started on our next panel, even as everybody kind of settles in here. So I'm joined by my amazing former colleague and mentor, Maggie Peloso, and she doesn't need any additional introduction because Sarah already gave one. But I'm very excited for this panel because Maggie and John each bring a unique perspective based on both their in-house role and their exposure to actually operating under these different reporting regimes in other jurisdictions. So without further ado, Maggie and John, and Maggie, if you are okay answering first, right? How does the SEC rule interplay with these other international disclosure regimes that companies are subject to? Where is it more stringent? Where is it less? And how does this create problems as companies try to juggle these different requirements?
Thanks, Matt. Thanks to V&E for having me, and to the wonderful V&E team for putting together this chart and making my job here easy. I know John's going to talk about California. So the two main disclosure regimes that I'll highlight here are the European requirements under the Corporate Sustainability Reporting Directive and the standards of the International Sustainability Standards Board, or the ISSB. The European rules cover a broad swath of sustainability topics that have to be disclosed under a double materiality threshold. So in the EU, you have to look at whether a topic is financially material or what they call impact material. And if a topic is material under either of those two standards, then the disclosure that's required is rather granular and requires the development of KPIs that the entity has to report on. The ISSB standards are made up of two parts, one specifically for climate and a broader standard on sustainability. One of the interesting things we'll see as jurisdictions move to adopt those standards around the world is that it's a separate step for a country to take the ISSB standards and turn them into national level regulations. And we are already starting to see some variability emerge in how countries are doing that. So for example, in Australia, they have chosen to adopt just the climate standard, and they've had to then cherry pick out some pieces of the general sustainability standard to make the climate standard stand on its own. The ISSB climate standard is largely a TCFD standard. The TCFD has actually now been folded into the ISSB, but it requires a number of more granular quantitative disclosures that those of us who have been engaged in TCFD reporting in a voluntary fashion in the US would not have necessarily seen before. Things like the amount of capital that you're spending on things like your transition strategy. So that's one to just watch for some emerging differences going forward.
John, what about the California climate laws?
Yeah, so I've probably spoken to some of you all about the recent California laws that passed in October. That is an interesting development in the way that the California legislators were thinking about, disclosure here. They basically took a very different approach and basically under SB 253 have declared that materiality doesn't matter. They just want everybody to disclose full stop, their scope 1, scope 2, scope 3 emissions, and they'll be putting that up on a publicly available portal. There's some debate because they didn't actually fund it in the last budget, and now it's subject to litigation, so it's a little unclear where that's ultimately going to land. But they took a very different approach, and I think, we hosted a webinar with the sponsor of that bill, State Senator Scott Wiener, and he basically acknowledged that the entire purpose was to just put it all out there, make everybody do it. I think that there may be some level of kind of, once it's out in the open, there's going to be reputational damage and it's going to incent companies to start decarbonizing their operations. I think to the point that I was making on the previous panel, given that the way that the SEC has described scope 1 and 2, if material, the fact you're now going to be having to disclose this information under California rules or the CSRD or ISSB, wherever you may have to do this, those could turn your scope 1 and 2 emissions reporting into material things under the SEC rules. So, I would just be very careful, just acknowledging the fact that there's going to be some unintended consequences with, the fact that there's going to be this patchwork of laws that's going to apply to a lot of folks, and it's going to require disclosure. And a lot of you in this audience may be like, well, I don't really do business in California. It's very broad and intentionally so. The way that it's constructed is if you are a public or private company, so this is very interesting because this isn't necessarily even sort of registrants who are going to be required to do this. It's also private companies. If you have over $1 billion in annual revenue and you do business in California, and the do business in California is not defined in the statute. However, looking at the legislative history and then talking to the sponsor, it's tied to how it's described in the California Tax Board, and that is an extremely low threshold. It's $610,000 of revenue in California, and now you have to disclose for your entire enterprise. Or you have $61,000 of payroll or property. So if you have one remote worker, you're doing business in California. Therefore, you're going to have to disclose against the California emissions reporting and not have a materiality threshold. There's some grace given in that you can use kind of under the GHG protocol, you can leverage basically estimates, and Matt can speak a little bit more eloquently about that, but it does sort of force every company, public and private, to put this all out there, and that's on SB 253. Then there was a second law, SB 261, which is basically mirroring the TCFD or the ISSB, so you have to put out on your website a report that essentially describes your climate risk management, and so it mirrors the 4 pillars of the TCFD report. I think that is probably going to be somewhat lower of a lift for folks just because they're going to be either complying with the SEC rule or they're already making voluntary TCFD-like disclosure. So that's probably not a super heavy lift, but it's interesting because I conceptually don't really understand how California has a dog in that fight, especially for private companies. If they're not really pushing and they don't have a remit to sort of protect investors like the SEC does, what that type of report is meant to achieve other than kind of put this burden on companies and then they have to verify that they're doing it on an annual basis. Then there was a third law. It's actually not described here on this chart. It's what's called AB 1305. Basically, this is if you're using voluntary carbon offsets, there's certain information that you need to put on your own website. And there was some questions around when the law actually was meant to kick in. It was sort of drafted so that January 1, 2024 was probably the initial filing threshold for this information. The bill sponsor put out a letter after the fact saying, my bad, I intended for this to be applicable January 1, 2025. So we're kind of in this weird limbo where the bill sponsor says it's not effective, but the law kind of sounds like it's effective. And so we think that, if you want to be very conservative, probably good to start reporting that if you haven't already. we think the enforcement likelihood is relatively low. But I think that component has some connective tissue to what we're seeing in the SEC rules, especially disclosure around the use of RECs or carbon offsets. And so you have to put out information that sort of describes how you're using RECs, how you're using carbon offsets. If you are making significant carbon reductions claims, and this is very broadly written, then you have to disclose under AB 1305. And so it's a little unclear to us, but if you are making a net zero ambition claim, or you're saying we have decarbonized X part of our portfolio, does that hit the threshold under AB 1305? Open question. All of this is to say that, I know the purpose of this conversation is really talk about the SEC, but there's going to be so many kind of interconnected disclosures for any company, whether or not they think that they're really doing that much business in California. And those disclosures are going to probably trigger obligations under the SEC reporting requirements. So just wanted to kind of put that out there, lay the groundwork. We have more writing on these sets of laws on our website. So go to velaw.com. I'm happy to kind of walk through kind of how the California laws will impact companies and what we're likely to see. I mean, the U.S. Chamber of Commerce has sued, and so it's potentially also going to get caught up in litigation. So we're not exactly sure how that's going to affect the implementation deadlines, but it's certainly an added complexity to all of this.
Well, and as John noted, there are different tests across all three of those climate laws for what brings in applicability, right? So just because you're out from one, you might actually be out from under two, given the way the TCFD law was written, but it doesn't mean you escape the offset law. And if you're wondering, this is insane, this is overreach, this is crazy, nobody's disagreeing with that. But what John's pointing out is, in talking to the authors of this legislation, that was their goal. So even if ultimately, legally, these laws are not upheld, the view of the authors is they are meant to have broad reach outside of California and only require very minimal contacts with California to make a company subject to them. So Maggie, you had mentioned how ISSB, or TCFD rather, has been folded into ISSB. Does the final SEC rule acknowledge that? Does it even kind of discuss whether or not that's going to really affect how reliance on TCFD under the SEC requirements may be impacted? Or is it really just we've all got to buckle up and get ready for the ride?
Yeah, Matt, the SEC rule doesn't really grapple with it. And frankly, it probably shouldn't. As those of you who went through the experience of commenting on the proposed rule with Matt and I will remember, there was a lot of talk then about the potential for the SEC to delegate to a third-party body to essentially be the climate standard setter. And just as a matter of simple administrative law, right, the SEC has an obligation to consider any standards and promulgate them through the kind of rulemaking that we've just been through here. So if the ISSB essentially evolves the the TCFD standard over time as it refines how the S2 standard will work, if the SEC wants to adopt that as regulatory requirement, the SEC will have to go back and do a new rulemaking to do that. I think that perhaps the more interesting question here is going to be how reporting evolves in practice over time, right? In many ways, the SEC rule looks much more like the TCFD standards than any of these other rules do. It is very principles-based. It leaves a lot of room for registrants to figure out what they want to disclose and what they don't. And in some ways, the ISSB standards narrow that field a little bit and say, we actually think you really need to disclose certain types of things. And so I think it will be interesting to see over time, as you have companies that have to report under both sets of standards, will you see an evolution of practice in the US where larger companies who are more likely to have multinational operations will be disclosing first under the SEC rules, where essentially what you see is a practical implementation of the ISSB standards in the US, even though that may be more than what's required? Or will we sort of evolve into a dual track system where you see a more tailored disclosure for US capital markets of the kinds of things the SEC rule says you need to disclose, and some of those other ISSB disclosures are existing in separate country-specific disclosures?
And so, John, one point of these disclosures, right, is to combat risk of greenwashing. The idea we put more information out there, the better informed investors are going to be. But so do we think the SEC rule is actually going to accomplish that? Is this really the right venue to combat greenwashing?
I can't speak to their motivation. I certainly think, it was alluded to a few times. I think that as we're seeing kind of the sort of hyper growth of these regulatory frameworks, and there's a lot of focus on greenwashing. I mean, that's clear. If you look at the plaintiff's bar has taken note of the fact that companies have been saying a lot of things largely unchecked for the last couple of years about their commitment to get to net zero, or they have a carbon neutral offering of some sort. Those types of things are now starting to get criticized, whether they're doing it through carbon offsets, which there's some dubious science around how voluntary carbon offsets are sort of validated, or even just the underlying premise is a little bit questionable. I think what you're going to see with all of these new requirements, whether it's the SEC or the CSRD or California, is there's just going to be a ton of new data that's out there that can be validated and verified and compared across industries. So I think you are going to see an uptick in greenwashing litigation. I think that companies need to be very cognizant of the fact that you can't just start saying things for marketing purposes anymore. These are now going to be much more scrutinized. These are now going to be filed with your 34 Act reports. And it's just a different level of scrutiny, but I also think that there's just going to be a lot more volume of information that's out there that's a little bit more comparable, since everybody's going to be forced to do this. And theoretically, which is, I think, the ultimate goal, is there should be some comparability across all of this. And so once you have the comparability, I think you're going to start being able to say, wait, you said you were on your path to net zero. You're nowhere near the path to net zero. Maybe I should poke at that a little bit. And so I think that you're going to start seeing some more litigation and also some regulatory action. So I think the net of all of this is, at least in the near term, you're going to see an uptick. Maybe longer term, it might plateau out, and actually this will aid in not having greenwashing once you have everybody sort of putting out comparable information that's validated, that's got the level of assurance from audit firms, et cetera. That would perhaps ultimately lead to this being a declining risk, but I think that there will be an increased risk. And for all of you who are at corporate issuers, I think you need to be very careful and also be very thoughtful about what kind of communication has been said within your firm that might not have been vetted by legal. Because, I spend a lot of time in-house. I know all of you have. There is stuff that's been said in your marketing department and your social media teams that have been probably not validated with the same level of rigor, that you're now going to have to kind of walk that back now that it's going to be up there.
Well, and just kind of watching out for that always there consideration of overly frank statements on everyone's opinion on certain initiatives, right? Like that could impact, hey, you've touted externally that this is such a big deal and important to your company and you're making this great progress. Internally, we see communications that you're not investing in this. With the potential for litigation, those kind of communications can get flushed out in the discovery process. So I think for those that are in the in-house legal department in the audience, everybody needs to think about what kind of messaging you need to be sending. Again, it's fine that an energy transition issue may not be material to the company, but I think you want to be very careful how you describe and deliberately talk about what you're doing here. So Maggie, in the US, where we already know the SEC final rule is facing litigation and that's going to potentially impact some of these implementation timelines. Is there the same kind of tension or brewing fights happening with respect to some of these international disclosure requirements, or is the writing on the wall for them?
Matt, I would say it's more the latter. I think that the political climate that we encounter internationally is really more and faster on disclosure. It's been remarkable to see the speed with which international regulators have moved to start to adopt the ISSB standards, not just in how quickly they started those processes, but how quickly they are moving those regulatory processes along. And I think it's important to underscore that in doing business outside of the US, there is much less concern about the litigation risks that might be associated with this kind of disclosure. And so I think that some of the regulators are maybe a bit more sanguine about that. And so we see a lot of momentum towards disclosure and disclosure proceeding apace. And I don't think that litigation over the SEC rule is going to change that.
And then this is for both of you, but John, if you don't mind going first, since Maggie just went. Given with respect to the SEC climate rule, we do have this litigation hanging in the background. We know it's virtually certainly headed for the Supreme Court. What exactly makes sense in terms of planning for compliance with this requirement?
Well, I think everyone should assume that it's going to survive in some form. I'm not saying that it will, but you kind of have to work under the assumption that it will, because if you don't and it survives and you're not prepared and all of a sudden the implementation date is right around the corner, then you're kind of behind the eight ball. And so I think you just need to sort of understand that you need to be realistic, but also start preparing realistically and not over maybe, invest in resources that ultimately might not need to be used. What I would say is kind of the counterpoint to that is you're probably going to have to do all this anyway, because under California law, or if you're doing business in Europe, all of those regulatory regimes are going to start requiring similar levels of assurance, internal controls, IT processes to start gathering this data, because you're going to have to report it somewhere. And so we can, maybe be optimistic that this is going to get held up in the courts and maybe it'll get struck down completely. But I don't know that that's going to give you the full kind of relief that you might be seeking, because in Europe, it's going to continue at pace. And even if you're not operating in Europe, your customers might be, and they're going to be asking this information because they have to report Scope 3. And so, in order to continue doing business with them, you're going to have to just do this disclosure exercise anyway. So I'm just a little bit, I guess, trying to be realistic about the fact that the SEC is, I think, obviously the top of mind for all of us, but it ultimately may not be what's moving the needle at the end of the day, because I think the ship is sailing, and we're just going to have to kind of understand the patchwork that's going on here and prepare accordingly, because California, like I mentioned, is going to probably capture a lot of folks, whether or not you think you're doing business in California, you're going to. Europe, same thing. I just think that it would be very imprudent to just completely put things aside and just assume that it's going to get thrown out in court, because you just got to assume that it's going to survive in some respect. And even if it doesn't, it's probably going to still affect you in some way.
And so, Maggie, that made me think of a little bit of nuance for the question I posed to you is, are you all set if you are subject to the ISSB disclosure requirements? And so you don't really care what happens as far as the SEC rules go, because you can just hack away at what you've already had to disclose in the EU?
If only it were that simple, Matt. Look, I think that going through the exercise of having to comply with the EU standards or with the ISSB standards for various operations within a company can teach you some important process things. I think one of the biggest pieces that is still a little bit undefined, and I'll be curious to hear from our EY colleagues on a later panel about it, is a lot of these disclosures will need to be audited. And one of the things that I think we often find is that internal sustainability teams have not historically been peopled by people from finance departments. That is changing. But so lots of times when you go through this process and then you're saying, okay, and now you have to write down what you did and you have to document why you decided that wasn't material, that's really different from the way that we have traditionally done a lot of voluntary sustainability reporting. So I think there are skills there that companies can learn that are helpful and transferable. John's point about data quality and validation, I think, is a really important one. And I think that companies that are disclosing under these other regimes will learn things about what level of rigor do I want to validate my data to be comfortable having a senior executive sign it. That will be important in the US context. And the last thing I would emphasize is that these regimes all require some level of value chain reporting or physical risk disclosure. And that's somewhere when you look broadly across the kinds of voluntary disclosures that we have, generally physical risk is really under disclosed. And that's an area that can be really data intensive and where I think that there's still a lot of work to do.
All right, well, that brings us to the end of this panel. Thank you, Maggie, very much. And thank you, John.
All right, moving right along. So what we want to talk about next is sort of the stakeholder perspective. Obviously, these rules were, derived from the SEC, who has a mandate on investors. But there's a lot of folks who are going to be reviewing these disclosures, and they're going to take from it potentially decision useful information one way or another. I think also we need to understand, are these rules even doing what they're intended to do? just coming out of the announcement, we've seen litigation both on the right side, but also on the left side. This has kind of pleased no one. The fact that the rules sort of watered down Scope 3 has brought the Sierra Club to bring suit. But then the fact that, that they're disclosing climate disclosures at all is being viewed as an overstep. And so we're seeing, lawsuits from various state attorneys general. I guess the question that I want to just kind of pose to this group as we start thinking about the questions that I'm going to ask directly to folks is, did the SEC even hit the mark here? Because I mean, in some ways, I think they were between a rock and a hard place. They sort of committed to putting out this new framework in order to have it pass through sort of the litigation gauntlet. They had to water it down in such a way that it displeased certain constituents. And so it's kind of a really interesting place where we're left with this kind of watered down thing that still pisses off a lot of people. And so with that, I would love to just kind of turn it over to Rodolfo and ask the question, does this final rule provide decision useful information to the shareholders? Or is this just simply providing kind of a reporting burden on companies? And is this actually information that investors really want to see the way that it's been constructed?
No, that's a key question that we should ask ourselves. And let me first just give a second introduction to myself, to do what Sarah said at the beginning. In addition to sustainability strategy, I also do corporate governance and activist defense work at UI. And part of this process is really helping clients navigate from shareholder proposals, and you can see how many of those come in the ESG arena, and also help from board fights to contested deals. But to this point about the work that we do, we generally go and ask investors every single year about what matters to them. And we do the same questions, ask the same questions to board members. And if we remove all the politics from this, for the discussions and specific views, and ask them, does it really matter? What we saw this year is there was a big, sometimes even a big disconnect between what boards were thinking and what investors were thinking. So to answer John's question, is it relevant? The answer is yes, to the majority of investors. And look, having the information, so the part of the questions that you see here is a question that we ask to investors saying, do you care about ESG? You're going to focus your stewardships with your companies on environmental and social issues. And you can see that removing any kind of political views, 98% are focused on that. They are going to continue pursuing. Internally, they're talking about ESG. So companies shifting the message about ESG to sustainability because they want to talk, ESG became kind of a dirt world in corporate America. But they're still focusing on the same topics. They still talk about this, and many of the clients that we have. And they're basically saying there is no pullback in terms of the effort here on ESG. And this includes both two different views. You might have investors here that believe that in terms of risk protection, they want to make sure that their company is into a transition plan. They're going to be net zero by a certain period of time. But you also have investors that might think that this is not going to have any kind of significant burden to companies. Is people are overreacting to the issue. And I'm going to make a contrary bet in the process because I believe that my investors are going to have a huge upside when people realize that that's not the case. But it's just pointing that this is part of the conversation. If we move to the next slide, that's part of the points that we made about the disconnect between boards and investors. When we asked boards, probably only 30% of the answers came back in terms of climate change, DEI, and other ESG efforts. Specifically, climate was the main one. And that was like they ranked a bunch of other things way ahead of climate in the discussions that they had with shareholders, their priorities for the engagement with their investors. Then we flipped and went to investors. It was the top of the agenda. If we flip to the next slide, that's the answers that we got from them. You can see that climate-related risk and opportunities was really on the top of the agenda for the discussions between investors and companies. I'm not going to get into these details, but you have to realize also that if you have a conversation with the PM or analysts at the fund that invests in your company and they did not ask a question about climate change, it does not mean that the fund, the asset manager, is not concerned about the topic. And I got some clients surprised when they had that same asset manager voting against them in our shareholder proposal, we support in the shareholder proposal related to climate. And that's the reason. Sometimes you have two different discussions internally, two different groups managing this, and you have just to understand how they play out. If anybody wants to go into more details, I can discuss that during the break. And but it's basically saying, look, the picture is that investors care. That's decision useful information that they're currently using to provide a little bit more color on the process. 75% of the shareholder proposals that were withdrawn in 2023, they were related to climate. So this means that companies saw the proposals and the proposals would be supported by shareholders, so they end up making an agreement with the fund and finding a compromise. If we flip the game to anti-ESG proposals, or proposals to basically reevaluate DEI and climate change resolutions from the firm, they are averaging less than 3% support, meaning that these are not really issues that shareholders care about. They're really focusing on the mitigation process, especially on climate change. We asked shareholders if they were more willing to vote for shareholder proposals in this year, and the 29% of shareholders, almost a third, said that they were willing to vote more for shareholder proposals. And we asked them why they're not voting. They said because the quality of the proposals are not good. They're not in line with my interests. But it basically shows that 30% show the disconnect between investors and companies, because investors believe that companies are not doing their best in terms of manage those issues. If there were proposals that were in line with their views, they would probably support them. And I would also highlight that we heard that board refreshment, shareholders now, especially with universal proxy, they would consider board refreshment even if there are not the case for change, just in terms of improving the board composition. And that falls into especially one thing that I think we're going to see more and more in the near future, which is a single issue director, like a director that a nominee that is proposed for the board just to address a specific issues that can be climate change. So as these risks become higher, regulatory environment becomes stronger and companies face additional risks, you might see situations that you have a nominee that could address maybe the lack of action of a company on a topic like sustainability. Then we go back to that question about, is it relevant? If I can skip now and I don't need to report on strategy and governance, should I? Strategy and governance, more than KPI, is what most of these investors are looking at. So if you want to avoid this type of risk, you probably should be discussing strategy and governance on your report. So it's just, that's why I said in the beginning, it's more than anything, it's kind of minimum requirements in terms of disclosure that are being proposed by the SEC, because investors are way ahead of that.
Thanks, Rodolfo. Turning it to Jessica for a second. When Sarah introduced her, I don't think she gave the full background of Jessica. She actually spent the last 8 years at BlackRock. I think it was 8 years. So she led the stewardship and investment management team at BlackRock. And she actually, correct me if I'm wrong, but I believe you were also involved in BlackRock's comment letter to the SEC. So a question I have for you, kind of putting on your institutional investor hat, what is your takeaway, or what do you think institutional investors are? They going to be pleased with this? Is this going to be what they were looking for? Is this going to actually help them make their voting decisions, which is obviously driving a lot of their behavior and driving a lot of corporate behavior, I'd say, in the last few years?
Thank you. So great to be part of this conversation. And I'll take a step back for a minute in, as John mentioned, having spent time on the BlackRock investment stewardship team and seeing how the largest asset manager in the world was responding to providing feedback on these climate-related disclosures as they were being formed. And I think something, Rodolfo hinted at this just now as well, but we at BlackRock have been asking for TCFD-aligned disclosures since 2017. And that was really to understand the governance, strategy, risk management, and metrics and targets components of how companies were thinking about climate-related risk. And I think what might be lost in these required disclosures is that narrative component that allowed us to have a launch point for our engagements and really to understand how the board was looking at these elements of risk from a physical perspective, from a transition-related perspective of climate, and get a sense of how strategy was considering that in a way that a long-term investor would seek to understand. So while I think these disclosures hit at elements of the TCFD that was really advocated for by large institutional investors for many years at this point, it's missing kind of the broader picture of how this is considered and integrated in everyday strategic planning where it's most material for a business. And I know we've talked about different elements of materiality in this conversation, but I think having companies or giving companies a point of view on what's most material from an emissions reporting perspective for them doesn't necessarily give investors a full picture or an apples and apples comparison across a peer set, which, the TCFD in its framework was broad enough and also allowed for that narrative component to help fill in some of those gaps. So I do think there are some critical components missing here.
And then maybe turning it over to Maggie for a second. Obviously, you can probably wear several hats for this conversation, working at a registrant, but also at one of the world's largest insurers. And I would love to get your perspective on how kind of insurance companies might be thinking about these types of disclosures. Does this help inform, your underwriting decisions and just kind of your general business operations? Or is this kind of much ado about nothing? Would love to get your perspective.
Yeah, John, I think it probably really depends on what kind of insurance you're talking about. I think the first thing that we really thought about was directors and officers insurance. As you and I discussed on this last panel, one of the potential consequences of this proliferation of really different regulatory regimes is that companies are going to be saying different things to different regulators in different places. When you combine that with the issues around materiality judgments that Sarah highlighted and some pretty granular disclosure requirements around who on the board is responsible for what with respect to climate, I think it's reasonable to expect that we could see the risk for increased shareholder litigation, drawing off of some of those letters we've already seen the SEC write to say, hey, why'd you put this in your voluntary reporting and not in your 10K? And I think that's a dynamic that we'll deal with whether the final rule stands or not. It's just with different information out there in different places, a strategy that we may expect litigants to leverage. I think the other interesting conversation that's been happening in the insurance industry is not so much around what our insureds are ultimately going to disclose, but is around the role that we might play in the data ecosystem, particularly with respect to physical climate risk. The final rule is much less onerous than the proposed rule. It doesn't have the zip code level requirements for disclosure. It doesn't have the value chain physical risk disclosures, but it still is going to require that companies do a lot of work to figure out if they have physical risks that are material. And so one of the things that we see in our industry and we're working on at Chubb is thinking about how we can take that data and information that we do have on natural catastrophe risk and make that available to our insureds to help them think through those processes.
Can I ask you a follow-up question wearing your sort of just public company registrant hat? Kind of how would you see the burden of this on your kind of management of the data that you're ultimately now going to have to report? I mean, everybody in this audience is probably facing similar things and trying to grapple with, this new reporting regime. Is this going to impact your life significantly, or are you feeling, the fact that you're already probably going to have to do this for your European operations, your California operations, this is perhaps not an incremental heavy lift?
I think the SEC has left companies a lot of room in a way that probably gets it right compared to some of the other rules, in that I do think the rule is trying to solicit disclosures that are actually relevant to business conduct and business strategy. I think that when we look at regimes like the European regime, when you drill down and look at some of those KPIs, there is a lot of effort that will go into collecting data that it would be fair to question how relevant that is to the business. And so I don't see this particular SEC rule as changing our approach in big ways, but I think the broader swath of ESG regulation, where it is more prescriptive in some places, can create burdens for data collection and disclosure that are not rationally related to the kinds of things that the market is trying to know about registrants.
Thanks for that. And so I'm gonna get the kind of litigator perspective in here. So I'm gonna turn it over to Rebecca for a second. Would love to get your opinion on how is the SEC going to be thinking about enforcement of these new rules, and what are their priorities going to be? Obviously, it kind of needs to get through a few hurdles, but would love to get your perspective, having sat in enforcement for so long.
Yeah, definitely. And I guess, depending on your perspective, one angle of this is that the SEC can already police so much of this just through the disclosure rules. They've had the ESG task force for, I think, 3 years now. They've brought several cases under it. All of that was pre these rules coming out. And so I think, and this has been alluded to in earlier panels, continuing to exercise great care and perhaps increasing care with the way companies describe narratively how they're approaching various things relating to climate and the S and the G also of ESG. That's going to be really important because there is no doubt, regardless of the legal challenges to this set of rules, it is something that the staff is very, very focused on. And you're seeing that in cases where, once the staff has an investigation in a company, even if it's for something entirely unrelated, they're going to look at your most recent K. They're going to look to see, how you've described various things, or in your sustainability report or other documents that you've furnished or filed with them. And they can ask questions in that very broad investigative power of, where's your support for this? What's behind this? What can you show to support this sentence? And so I think just the fact the rules are out there lends itself to additional risk of being asked questions about anything that you're disclosing and reporting. And I just saw the next panel is going to get into the disclosure controls and procedures, which is great because that was what I highlighted as, I think, the biggest initial risk from enforcement staff. It takes a while to build a fraud case. It doesn't take that long to build a disclosure control and procedure case because you can bring that charge as a staff member without an underlying disclosure violation. So you could look at a company and think, as an SEC staff member, they are not getting the right information to management or to the people who are deciding what goes into those disclosures. And that is a de facto non-scienter based, you don't need, recklessness, negligent, any kind of mental state. You have a failure of your disclosure controls and procedures. And that charge and that entire enforcement action does not have to be paired with a finding that your disclosures were actually not sufficient. And so I think getting your house in order, getting those protocols and plans in place is going to be absolutely crucial, because I would expect as soon as these rules are active, I don't think we'll see enforcement cases right away. That takes a while. I think you're going to start seeing staff ask questions about how companies are working to make sure these rules are being complied with in those filings that are coming out.
And just, we've only got a couple minutes left. I just want to turn it over to you, Sarah. Obviously, you represent a lot of restaurants, and there's a lot of heartburn over putting out stuff that's going to have unintended consequences. Can you talk a little bit about some of the risks that you see with how these rules are crafted and what that might force?
Sure. I mean, my view of the risks is an amalgamation of everything you just heard. So, you heard from Rodolfo and Jessica how this information is a priority, from Maggie on how a lot of this information is coming out in various manners, various levels of disclosure for different regimes. There's a lot of information that's being put out there that's responsive to shareholder requests or responsive to certain disclosure regimes that you probably look at and you ultimately think is not material. You're going to conclude it's not material. And there's going to, there may be a disparity between the information writ large that's out there about your company with respect to climate and sustainability matters, and in particular risks and how you manage them. And then there's going to be what's in your SEC report, and there's going to be opportunity for people to poke holes at both sides of that. There's going to be opportunity for people to say, look at all these things you disclose in your sustainability report. Shouldn't they, aren't these material to your company? Why haven't you put these in your SEC disclosures? These are deficient for all of these reasons. Or you say, okay, we're going to take a conservative approach here and say, okay, we think that these possibly could be material. We put these in our SEC disclosures. And by the way, we now have to outline how we are, the governance around these, at least at a board level, regardless of whether or not we think it's material. And then people come and poke holes at that. And there's a fiduciary duty to see, like, you said that this risk was material. You're not properly managing it. You're not, properly crafting the board's strategy around it. So I think it does, that the disparity of information that's going to be out there, I think it does present some risk. And I think someone had asked a question of, have we seen something? I don't know that there's been something that's quite the level of these rules, but I do remember that when the executive compensation disclosure rules came out, which of course elicited a bunch of information, a lot of which is arguably immaterial. I mean, there was the result of that was that there were more lawsuits around compensation, more lawsuits around fiduciary duties, around compensation, most famous of those being the recent Elon Musk suit. And then a lot of, people taking actions or, looking at things and wanting to have like greater dialogue around how people are managing that and, really managing risks around, strategy and how that's tied to executive compensation. So I think all of that's going to come out here. That's not to say that I think we would be better off without some kind of materiality applied to the rules, but I just think it does create risks, and people are going to have to be really thoughtful about how they make those assessments and how they make those disclosures and how they set up their governance and controls around that, which is a good segue to the next panel.
Agree. And I'm stealing 2 minutes from that panel because I'm not on it. And just noting that in the past of sitting in the SEC, oh no, I don't need to. Yeah. This is all I have to add. But there's a bigger risk, I think, and they can counter me on the next panel, but even if you determine something's not material, that information, any information surrounding anything that could be material, needs to have some sort of documented path up to decision makers in the position of making the disclosures to support that. The staff is not, kind of like with the Corp Fin experience, it's not so much that enforcement staff is going to second guess the business judgment of those making the decision. I mean, maybe, but generally that's not what they're doing. They're looking at, is there a process that ensures that all the relevant information that could come to this materiality decision, which is a qualitative, not quantitative decision, has that information gotten to the people who need to make it so that they could make the right decision for the company on behalf of the shareholders and for investors. And just trying to view it in that framework will be helpful. It also gives you something you can show the staff when they ask you, how did you make this decision? It's hard to show how you made a decision if you made a decision not to do something. And having a procedure that gets information to someone gives you evidence to show, here's how we reach that. And that is very helpful when it comes to responding to requests from the staff.
What we want to talk about a little bit next is how do you put this into practice? It's great to understand the rules. We all want to understand the rules. How do you implement this in your companies? The key, I think, takeaway is what's going on. Obviously, we need to understand the rules, but now I need to bring this back to my management team. I need to bring this back to my board. I need to start talking to them about the resources that I need, the staffing, the budget. I might now have to engage audit firms. And so I need to start thinking about the practicalities of compliance with these laws. So with that kind of by background, I just want to turn it over to Rodolfo for a minute. How would you say that companies should be kind of working with their boards, thinking about their oversight responsibilities and, communicating to them? I mean, I'm sure everybody here is probably putting out an alert to their board of directors about the SEC rule that's come down. And so there's probably some awareness, but what's the next step? How do we think about what the board might need to be doing potentially differently? And, obviously we talked about this in the original panel. The rules were not meant to be prescriptive and sort of declaring you need to do X, Y, and Z. You just tell us if you're doing X, Y, and Z. That being said, I think that there's going to be a trend towards actual changes in practice. And so would love to get your perspective, Rodolfo, on what you think is going to be a result of this, and frankly, should there be some changes within the boardroom?
Yeah, the discussions that we have had with clients, one of the key issues, especially because many of them are already reporting under TCFD, was just take this moment to pause and review what you have done, review how you have been discussing the whole governance and also the strategy piece. You have to understand that from this point on, things are going to have you're going to get a lot more scrutiny on these topics. make sure that you're not thinking about this process as, oh, maybe I can avoid some of the information that I provided. I'm going to step back now. That's not going to be seen in a positive way by investors. So take this moment really as an opportunity to reevaluate what you have put on paper before and see what should be the guidelines going forward. So the first step is really studying again the strategy, what exactly is happening with the firm. Is it prepared for any climate-related issues and transitions in terms of, not only transitions, but also in terms of the risks that you can face in terms of hurricane? Do we have a strategy? Do we need to upgrade it? And that's really step one. And I can say that a significant amount of clients have reported because of the demands that shareholders were facing, but I don't think that this in-depth thought process has happened, a discussion that need to happen at the board level to basically get that direction in terms of strategy. So that's really step one. And then step two is going beyond, there is no one size fits all in terms of governance, but it's really understanding what's the strategy that you have and what that strategy demands in terms of implementation, both at the board level for the oversight. Do you have is it a topic that all the board addresses, or is there a topic that just you have a committee that is driving the discussion? And from there to the discussions at the management level in terms of, do you have a steering committee? What exactly are the structures that is going to have those discussions about not only the risks, but also the opportunities? I had a client that part of the steering committees had people from operations. They were discussing about having a new factory being built, and emissions profile in a location in the West Coast versus a location in the East Coast was part of the discussion. And part of this was because of commercial opportunities, that they could sell that in a specific angle that could favor them in terms of their consumer base and how they would see the brand. So having that mechanics in terms of what strategy is and how you get to the governance is the first part in terms of discussion with the board. And I'm sure that Carrie has some good points about the internal controls, because that's really the third piece of the engagement, which is you have to showcase that you have good data. And not good data just because of the data that is being required to be disclosed, but it's data to manage whatever strategy and governance you're trying to the governance that you have to try to implement that strategy. If you don't have quality data, and I've seen situations numbers went up by 50% just because we did a review, that's going to break the trust that investors have with the work being done by the board. So in terms of the work, the discussion with the board has been mainly on that. Review your strategy, make sure that the governance is adequate, and make sure that you have the numbers that you need to have to manage it.
Sarah, so as you think about governance, I mean, I alluded to it in my question to Rodolfo. Do you think that these rules are going to change behaviors within the boardroom, and should they?
Look, I think anytime you have to disclose something, there's a lot more attention to, how are we doing this? How are our peers doing this? Are we doing this properly? But theoretically, you should be already managing the enterprise risks of a company, and as part of that, having board oversight of that. And so this, all of this, to the extent that climate is material risk with respect to your company, is something that should be, adequately managed as it is. But I think, look, again, we've said this already, there's materiality thresholds on a lot of these disclosures. Board governance, there is not. So you will be disclosing that. And so there's going to be a lot of attention on that. And some of the work, but I do think that people have already done that, just given the enhanced scrutiny around climate and emissions and related disclosures already. So people have already drilled down on this. But some of the things that we've done with people is sort of helping them map, okay, here's how we do our climate risk assessment, both of transition risk, physical risk. This is how it happens at our company. And there's not one prescriptive way that it needs to happen, because it's completely dependent on your industry and what the risks are that you're trying to assess. Here's how it happens. Here's how that data gets pushed up. Here's the timeline on which it happens. And then here's how that information trickles up to whatever governing bodies are responsible for managing those risks. And this is how it ultimately trickles up to the board. And this is our governance design around this. And that's all mapped out. And sometimes there's specific charters that address that. Sometimes it's part of a broader charter. to the extent that you are saying you're doing these things. A second thing that we've done is, because a lot of times there's sort of this mapping exercise, and there's the question, are we actually doing this? Is this the way that this, the governance of this actually working within our company? Does it make sense for it to be this way, or do we need to adjust that? And so I think over the last 2 years, we've had a lot of those conversations with people, like what makes sense in terms of our company for making sure that we have proper oversight of this. And now there's going to be this additional tension, because there's going to be a lot of judgments about materiality judgments and what does and does not go into this disclosure, assuming these rules survive. And so that puts greater tension on that. And how does that fit into the strategy of the overall company? And that'll be, part of the assessment that goes into a lot of these meetings. And then, as Carrie, I'm sure we'll talk about a little bit more, just making sure that you've built the appropriate internal controls to be able to not just report these things externally, but even like reporting the information up to people for them to make that materiality assessment. Like what are we doing to actually gather that information? Is it a sound place to start in terms of assessing the risk?
And maybe just to jump in quickly here as a follow-up to Sarah's comment. I had a panel. I was in a panel recently with some of the larger asset managers here in the U.S. And one comment that I heard was that we're talking about generative AI and how they were seeing companies managing generative AI. And what they said was this: governance is the most important item in the agenda. So think about all the data that you have that are being requested here. But the point that they made is that governance for Gen AI is the most important thing, because we want to make sure that people are ready to manage whatever the risks are coming the direction of the company. By the way, that's the same requirement that we have for climate. That's the statement that I heard there. So that you can imagine about how important the governance discussion is on this topic.
I'm going to pass it over to Carrie in 1 second, but I want to address a question that came in on screen here. Someone was surprised to hear verbiage like mandatory disclosures under TCFD. It may have come from me. I think that was probably a misstatement. TCFD is voluntary. However, what I would say is TCFD is being used as the kind of model for some of these mandatory frameworks. So in some ways, yes, it has historically been a voluntary disclosure framework. However, it is sort of being transposed into the ISSB. It's also kind of the foundational premise for the SEC rules. So therefore, it is kind of evolving into a mandatory framework, if you will. But if I mentioned mandatory reporting under TCFD, that was just a misstatement, so I apologize. Passing it over to Carrie real quickly. Obviously, as we try to implement these reporting requirements within an organization, there's going to need to be new processes in place. There's going to be maybe kind of sense checking our financial reporting controls and kind of applying the same levels or similar levels of scrutiny that we do for other things that get filed with the SEC. Can you talk a little bit about how registrants should start gearing up and what we should be thinking about as we're kind of marching towards the rule implementation date, assuming it survives litigation?
Yeah, I'd be happy to. So the way I typically think about this is really starting with the initial year of putting that information in the SEC filing and kind of assessing at a company level, where do we want to be in terms of our confidence around those numbers and our kind of readiness to mitigate any kind of restatement risk we may have related to that information. So what some companies are doing, and actually Rodolfo, I think, mentioned it earlier, we are seeing with companies as they begin to calculate their Scope 1 and 2 emissions, we are seeing a number of changes in information, recognizing it's at the moment in kind of a voluntary world, but having multiple years of data where you can really compare and think about changes in the business and do those fluctuations from year to year, do those make sense? That's one consideration that many companies are making in advance of any kind of SEC reporting. Another area that you mentioned is around process and controls. So we saw a big uptick starting about 2 years ago when we had the proposed rule come out, with companies wanting to begin to document their processes and then also embed controls similar to what we see in the financial world. We typically are seeing companies involving finance folks in those types of activities within the organization. I think there was a comment around that a little earlier. So that's another space where we're seeing quite a bit of focus and enhancement. The next is around the role of internal audit. So once those controls are in place, or sometimes even before that, we're seeing companies begin to do special reviews of that information, tracking the data, seeing if there's consistency or calculation errors, anything like that. And then we do expect in the coming years to start to see internal audit reviews of those controls once they're in place. The last thing I'll mention is we're also starting to see more and more companies do limited assurance, and we're also seeing some shifts in limited assurance providers as these rules are quite integrated in with the financial statements. We're seeing shifts from engineering firms to more accounting firms, and often those transitions, we're seeing companies plan ahead so that that's not occurring once that information is part of a public SEC filing.
And just one quick follow-up. Carrie mentioned this, and I had mentioned before about this sometimes discrepancies that we see in increasing some of these numbers. Just to demystify the conversation, to not give the appearance that we're talking about companies trying to mislead investors or mislead to whomever they're reporting the data. Sometimes these disconnects happen because we had half the company calculating emissions under invoices that they had regarding some service that you're providing to clients and the fuel that they would use in terms of transportation of those some goods and services that they did directly, versus other parts of the company doing the calculation under specific utilization of the fuel. So they had the data about how much fuel was used in the vehicles. So that was enough to create a discrepancy when we basically tried to harmonize and create internal controls, and the procedures were the same across the board. So that ticked up the emissions calculation. So it's not just people acting bad faith, it's just making sure that you have your process is structured in a way that you are sure that you're not going to have any kind of fluctuation in terms of these numbers.
Yeah, and we've seen that too, right? Especially with companies that are reporting under multiple jurisdictions, and then you're required to report one way for this jurisdiction, required to report this way for another. And then when you're trying to come up with sort of your global number, it's inconsistent. And they're like, okay, which reporting protocol do we use? I think there were some questions around that earlier. And so there's been a lot of work done around that. And then also just how does this information get reported up, like who's charged with it, who's verifying the accuracy of that. So there's a lot of that going on.
And just last question for Carrie, there were a lot of rumors that SX was going to be scrubbed completely from the final rule, and we actually saw that it was there. And that obviously has certain accounting implications, and it's going to be something that a lot of registrants are going to really have to grapple with, is like, how do you even determine, your acute and your chronic climate risks, and how are you going to be reporting that within your footnotes and your financial statements? How should you be advising folks to be thinking about that?
Yeah, so the focus there is really on the severe weather events and other natural impacts. And for the most part, over the last 2 years, we've seen, very little focus from companies in that space because there was so much belief that, that would likely come out or maybe move to elsewhere outside of the financial statement footnotes. We have noticed a number of companies do have some processes around insurance, tracking for insurance purposes that they may be able to leverage. And then there are also existing processes and controls around expenses and capitalization that can certainly be linked in and leveraged. But, we don't, not really aware of any companies that are currently tracking data at the level that is requested. So there's definite need from companies to be thinking through the policies, processes, control enhancements, and then ultimately the disclosures that will be needed.
And at least the implementation deadlines this time give you time and a chance to think through that and get the appropriate controls set up so that, by the time you're reporting on those SX related items down the road, that you have adequate information, which the proposed rules definitely did not.
Yep.
Great. Well, that's the end of this panel. I think we're going to take a break. How long do we have?
I think we're going to take a 10-minute break, but the next panel to me is probably one of the most interesting because it's all about the litigation and timing considerations. And there's a lot of massive game theory around the jigsaw pieces of litigation here and what's going to happen and why people were filing where and the various theories under which they're filing and which courts, which is all very interesting to legal nerds like us. But it is, it's super important to understand that, and your board's going to want to understand that, because I think what you've heard here and all the prior panels is no matter what, even for the most prepared companies, there's probably a significant amount of additional resources that would have to be invested to comply with this rule. And so is it possible, as you think about the litigation and the timing of that, and as you find out stuff, is it possible, given the implementation deadlines, and of course that's going to be specific to each company, to stage some of this as you try and, and assess whether or not this rule is going to survive, or in what form will it survive? Now, as we've said, look, a lot of you are going to be subject to this kind of reporting in other jurisdictions. And even if it's not an SEC filing, there's a lot of reasons, including enhanced scrutiny around greenwashing and other sort of regulatory actions around these specific topics where you're going to want to invest the money to get it right. But I think the litigation element of this is so interesting. So that's what's coming in 10 minutes.
All right, we're almost to the happy hour, I promise. But we'll kick off our last panel here, which focuses on some of the litigation issues and how that impacts how companies should be thinking about compliance with this rule, or what steps might be reasonable in light of, again, the litigation risks we got going on. So I'm joined online by my colleague, James Dawson, again, one of our appellate attorney experts, Corinne Snow, who's one of our environmental litigators and also has extensive appellate expertise, and then Sarah Morgan, who needs no introduction because she's been driving this presentation all day. So to get started, Sarah, I wonder if you might have any thoughts kind of about how this litigation risk in the background is going to affect compliance considerations, implementation for registrants.
Sure. I mean, I think we've talked about this with all of you guys since the proposed rule came out. There have been litigation schemes that have been planned literally since the day after, we got the proposed rule, let alone the final rule. And a lot of questions around, okay, this gets adopted, what does that mean for me? And also, if there's litigation, does that mean we can disregard this for the time being? And so, there's the two components of litigation. There's the substantive litigation over whether the rule is going to be challenged, and then is it stayed in the meantime, because the possibility that the burden is so big to registrants that they need to stay it to sort of figure this out. And I'm not going to steal Corinne and James' thunder, but that happened almost immediately, right? Like, we know that it's been stayed by the Fifth Circuit. And so as soon as we put out the news alert on that, I literally got instantaneously 3 emails. So does this mean we don't have to do anything? And, again, if you're not a large accelerated filer, not an accelerated filer where you're not even looking at an implementation of this until several years down the road, again, you can kind of back into a timeline of, what you have to do right now is at least understand the rules, understand what they mean for your company, understand where you are right now. And we sort of did this with a lot of people when the proposed rules came out. Okay, what's our gap analysis? What's the gap between like what we're doing now, our capabilities right now, and what we would need in order to comply with the rules? You are going to have to do that because you're going to need to understand what the gap is, describe it, to your management team and your board, and also understand what the timeline is for implementation of that, right? Particularly if you're someone with sort of one of the nearer implementation dates, like a large accelerated filer in 2026 for 2025. But that being said, to the extent that, some of these measures you guys don't think you would be doing anyways to support overall disclosure and strategies for the company, and they're going to take a significant amount of resources. And depending on your implementation timeline, there probably is a staging of deploying resources towards having to comply with this rule. And so that's where the litigation and tracking the litigation and understanding the variety of outcomes that might happen from the litigation is important, because if this is not things you're doing already where you can easily and readily report, and it would be a significant amount of resources for your company, then you may think twice about, turning on, all engines to be able to comply with this. But I think to answer the question of like, does this mean we can do nothing? No, I mean, and I don't think the people meant that literally, but it was more, at a bare minimum, you have to understand the rules. You have to understand what they mean relative to your company, and then understand sort of where your gap is, and then the timeline it would take to fill that gap. If for some reason the courts find that there's absolutely nothing wrong with this rule, the stay is going to be dropped and it's going to be implemented as is, right? So you have to be prepared for that scenario amongst many, many others. And I'll turn it over to, I'll let Matt talk with my colleagues about that.
But it sounds like even if the litigation may affect the ultimate timeline, the gap analysis is really key to make sure you don't hit a crunch at some point if something doesn't play out super favorable to your company in terms of the litigation.
Yes, exactly.
So, Corinne, we got the final rule. The SEC changed quite a bit. They've added in materiality qualifiers, notwithstanding kind of the concern I raised that I think they're still going to push everybody to use GHG protocol. They provide flexibility on how you disclose emissions. They backed away from value chain reporting. That didn't really stop the litigation, did it? And how did that kind of evolve?
No, that's right. So in many ways, the comments were very effective here. We talked about how many comments they got and how unusual it is to get that many. And you really did see how much they scaled back. And I think in part in recognition of all the litigation risk that they were going to face when this rule came out. And they certainly have. So we have had 9 petitions already filed in 6 different courts of appeals. So we have industry groups, industry members, and red states who are challenging this rule in the 5th, the 6th, the 8th, and the 11th circuits. And then we have environmental groups who are challenging this rule in the DC Circuit and the 2nd Circuit. As you know, the 5th Circuit has gone ahead and stayed this rule. And we really don't know, other than based on the 5th Circuit litigation, what people are planning to argue here. Because unlike a complaint that you would see in a trial court situation where you have to lay out your arguments and your facts, a petition for review, you just file a short document that says, we challenge this rule, and you attach the rule. So, we don't know yet what the environmental groups might want to say in terms of the rule needing to be more stringent. We don't know what a lot of these other groups are necessarily going to say. We do know what the 2 industry members in the 5th Circuit litigation are arguing, because they are the ones who filed a motion for the court to stay this rule. And to do that, you have to outline your reasons why, in effect, you think you're likely to win this case. And so there they raised a couple arguments. The main ones were that it's unconstitutional under the First Amendment, that this is forced commercial speech to force these companies to talk about a political issue, climate change. They said this is beyond the authority that Congress gave the SEC by under what's called the major questions doctrine, something the Supreme Court talked about in a recent Supreme Court case called West Virginia v. EPA, essentially saying, SEC, you're out of your lane here. You are not the climate cop. This is not what Congress meant for you to do. This is a major political issue, and EPA has already been given the authority to require greenhouse gas disclosures, not you. And then they raised a number of Administrative Procedure Act claims. These are more procedural claims. These are the kind of nerdy things that me and James, do a lot of in these regulatory challenges, where you find sort of reasons why they didn't comply with what they were supposed to do when they put a rule out. Here, it's that the final rule is so different from the proposed rule that people didn't get an adequate chance to comment. Things like the record that you looked at here, the evidence that you had before you, SEC, doesn't support having this rule. And I think understanding the breadth of those arguments is important too for thinking about how this rule what could happen if the court rules against the SEC in this case, right? Because it's going to be a very different outcome if they say this rule is unconstitutional or the SEC never had the authority to pass this kind of rule, than if they say something like, well, SEC, you violated some procedural requirements when you made this rule, go back and try again, right? In some of those scenarios, you may have a new SEC rule that looks like this or a little different from this, even if they lose in court. In other scenarios, you may have a court that has fully spoken and said, you guys don't have the power to do this. So that's at least where things stand right now. We have an administrative stay from the Fifth Circuit, but that is by no means the end of the story.
Well, and so James, maybe you can talk a little bit about how we expect things to play out, particularly with respect to the administrative stay.
Sure. So thanks for having me. As you've mentioned, so last Friday, the Fifth Circuit issued an administrative stay in a one-line unpublished order. And if you are confused about what the difference between an administrative stay and a regular stay is, you are not alone. This is a very hot topic in academic circles right now. And Justice Barrett actually just issued a long opinion about this about an hour ago, which is so far pretty much the longest treatment of the issue that we've ever received from the Supreme Court. I'll start on sort of the easier side of the question. We know what a normal stay is. A stay pending appeal is a court order that essentially pauses a rule while judicial review unfolds. That type of relief is explicitly authorized by Federal Rule of Appellate Procedure 18, and there's an agreed multi-pronged standard for how you get one of those stays. You show that you're likely to succeed on the merits, and you're going to suffer an irreparable harm, and that the public interest favors a stay. The harder question is, what is an administrative stay? What is this thing that the Fifth Circuit just entered? Well, administrative stays are not authorized by the Federal Rules of Appellate Procedure. It's sort of like the Wild West of appellate practice. These are instead supposedly grounded in a court's general, equitable, or inherent authority, or maybe under its authority under something called the All Writs Act, which is a statute that goes way back. But the main difference is that the purpose of an administrative stay, which is what we have in this case, is just to preserve the status quo until the court can rule on a request for a full stay, the type of stay that's contemplated by the federal rules. In practice, these administrative stays can sometimes last months, but more often than not, they are followed up with a second, longer, more reasoned order in which the court says, I'm either going to grant a stay under that three-part standard or I'm not. Importantly, there's no agreed standard for granting an administrative stay. And in fact, Justice Barrett just said this morning that the key standard here is sort of minimizing harm rather than whether or not you are likely to succeed on the merits. And to me, I know everything I've just said sort of sounds academic, but I think it's really important for this reason, which is that yes, the rule is on pause, but what we have right now is just an administrative stay. It's not a full stay. And so stakeholders need to be aware that this stay could go away at any time, and that the court's decision to grant it was not necessarily an indication that the Fifth Circuit believes the challengers are likely to prevail on this rule. So that's that piece of it. In terms of what we are expecting next, buckle up. It is a very complex and interesting process. Basically, the problem here is that Congress has struggled for decades to figure out an answer to this question of what should happen when different people file challenges to the same rule in different courts of appeals. It used to be the case prior to 1988 that there was a very simple rule. The litigation would just proceed in the first place where any of those lawsuits was filed. That is not the rule anymore. In 1988, Congress passed a statute that is now codified at 28 USC section 2112. It's a very strange system that, for better or worse, we here at V&E have had a lot of experience dealing with in the last couple of years. Essentially, the process is that the agency collects all of the cases that were filed against them. They put them in a package and they ship them to this body that is called the Judicial Panel on Multi-District Litigation. And then the panel conducts a lottery. It's literally like a physical lottery. They pull entries out of a drum to decide which court from among all of the courts where these cases were filed is going to win the lottery. And once one court wins the lottery, the agency is obligated by statute to file the record in that court of appeals. And then all the other courts transfer their cases to that court that has won the lottery. So the idea here is that all of the cases are consolidated. They proceed together in one kind of random place which then eliminates the need for folks to have their couriers sitting at the clerk's office to try to file a petition for review like a second after the agency issues its rule. So in this case, the agency has already sent the petitions for review to the panel. That happened about an hour ago. So the panel has opened up a docket for this case. They have not yet run the lottery, but they will probably tomorrow, if not tomorrow, the day after. And then there will be a circuit that wins. And then the SEC will go file the record in that circuit. And generally speaking, it is likely that the case is going to proceed in that place. There is one sort of nuance to this, which is that even after one circuit is selected in this lottery process, parties can still file what's called a motion to transfer for convenience. And what that motion would say is, look, I understand that the Sixth Circuit has won the lottery or the Eighth Circuit, whatever it happens to be, but it would be more convenient for us all to do this in the Fifth Circuit because more of the petitions were filed there, or it would be convenient to do it in the DC Circuit because that's where all the lawyers are, whatever arguments they want to make, and then it would be in the court's discretion to decide whether or not it wanted to transfer the case. That receiving court can also lift the existing administrative stay if they want to, or they could issue a published order that sort of continues the stay as a real Federal Rule of Appellate Procedure 18 stay. Anything basically could happen up to and including potential Supreme Court intervention. So if this receiving court ultimately decides to keep the stay in place or issue a new stay, one of the aggrieved parties could go to the Supreme Court's what's called their shadow docket, it's basically a motions docket, and ask that the stay either be reimposed or lifted depending on how they want to proceed. And as Sarah mentioned, there's sort of two parts to this. The first part is the stay part, and then of course there's the actual litigation of the case. After whatever motions that are going to be filed on a stay are filed and litigated, the parties will of course file their full form briefs. Those will go to the Court of Appeals, and the Court of Appeals ultimately will issue a decision. The national average for the amount of time that it takes for a petition for review to be filed is about 10 months. It's a little shorter in some circuits, maybe a little longer in other circuits, but we basically expect that this process is going to take about a year. And then after that, obviously, either side could go to the Supreme Court. If the case does end up going to the Supreme Court, which we think is pretty likely, it is possible that the court may not ultimately issue an opinion in this case until June 2026. So we could be in for a wild ride, and there's a sort of bunch of moving levers here, very difficult to predict how this thing is going to unfold.
Well, and just to unpack some pieces there, right? So these cases can ultimately end up in, one of these different jurisdictions, all of which have wildly different judges and people that would be deciding this. And then there's so you don't know if the stay is going to stick, if the Supreme Court's going to intervene. If the stay doesn't stick, you need to assume, until the substantive decision is decided, that you are complying with the rules. And then James just said it may be that the substantive decision isn't decided until sometime in 2026, which is well past the first compliance date. So you can see how all of the multiple choice on what could happen with the litigation is, incredibly, incredibly important to implementation timeline. And I know it's not extremely useful to you guys to say, and here are the 12 options, or, actually probably way more than that of how this could play out. But that literally is what you were, what he just explained very succinctly is what you're dealing with here, and why part of your implementation of this rule is just going to be ongoing monitoring of what is happening with the litigation with respect to this rule.
So Corinne, with all this in the background, I'm going to kind of pose the same question a little bit differently that I gave to Sarah at the beginning to you. What should companies be doing? And are there certain things that, if they are going to get involved in litigation as an intervener, might actually hurt some of their arguments or positions? Kind of, are there traps people should be worrying about?
Oh, yeah, those are two really good questions. So I'll start by saying on the compliance side, like everyone has said, don't assume the stay is here to stay, right? We just have the administrative stay. All of these courts, everybody is filing right now in their favorite court, so they got a ticket to the lottery, and we got a question online, if you have more suits in a particular circuit, do you get more tickets to the lottery? No, unfortunately. One ticket per circuit where people have filed. But that also might be part of why you've seen these environmental groups file in courts. They think are going to be more favorable to upholding the rule because they want to make sure those circuits are in the mix. So we'll know soon who is going to hear this and have maybe a little bit better sense of how it's going to come out on the merits. But again, as James said, we have a short-term stay. We don't know if we're going to get a longer stay during the litigation. We don't know what the outcome of the litigation is going to be. In situations before where a rule has been upheld, but you're now past the period where the compliance dates have set in, usually there's some amount of briefing to the court separately on remedy, or the parties will kind of negotiate, what makes sense to do here in terms of giving everybody a little bit more runway to figure out what to do. But it's certainly not something you can assume you're going to have. For people who want to get involved in litigation because this looks like fun and they don't feel like there's enough people already in this food fight, you have 45 days from when the first challenge is filed to be what's called an intervener, which is just kind of, you're not challenging it, but you're jumping in on the side of one party or another, and you get to file your own separate brief or a brief with other interveners, kind of depending on where this ends up. People can still file their own challenges to this rule. They won't be part of the lottery at this point, but they can still do it and still join in. And I think May 3rd is the deadline to do that. So we may see even more people jump in. You can also do what's called an amicus brief, basically a friend of the court if you think you have, a perspective to lend here. But ultimately you have to, other than as an amicus, you have to have some sort of injury. So you're right, Matt, there are things you could do to start complying that might mean that, well, you've already done everything you need to do. So what are you complaining about? And then in terms of what can you be doing now, Sarah touched on a lot of this, John touched on it earlier, but a lot of this is just getting your hands around what you've done so far. Probably a lot of these statements have been made by different pieces of your company in a lot of different types of documents with a lot of different purposes, and seeing what you've said. If you've already been doing reporting, not assuming that you've already checked all the boxes and you already have all the systems in place to go ahead and comply with this rule. So as Sarah said, those gap analyses, seeing what else you might need to do. When we were working on the comment letters for this, a lot of people raised the fact that there didn't seem to be enough advisors and attestation providers for everyone to do this, which might mean if you think that's true, you should go ahead and start finding one, right, before everybody else signs them up. And then you do find yourself kind of flat-footed without the advisors you would need when this goes into effect. And then, there are these, as we've described them, disclose if you have them requirements, right? So if you haven't started doing some of those things, think about whether or not you want to, because now if you do, you're going to be required to. If you've been making certain statements, or if you haven't yet made certain statements saying, you're going to be net zero, you're going to do X, you're going to do Y, it's going to be great, you're going to save the world. Make sure before you say those that you can back them up, that you have a real plan to do it, that, as Rebecca said, you're documenting what you're thinking about, because the stakes on making those sort of statements are going to go up if this rule stays.
Or at least if you're doing them, you're clear that it's in response to, some kind of other external prompt, and it's not because you feel that it's material to the company, because again, those all have the materiality layer on top of them now. So I do think, I think that's important. I think being mindful of your ongoing disclosures and how that fits into the overall, proposed disclosure regime here is going to be incredibly important.
And so we got one question from the audience. Corinne, I'm wondering if you could speak to, we're in an election year. How could a potential change in administration or a new SEC chairman impact this rule?
It's a good question. I'm more familiar in a situation where you don't have commissioners and you just have a full-in, change in administration, new head. But the general rule is you can only change a rule or remove a rule through the same process you went through to make it, which means outside of a court setting, if a new SEC came in and said, we don't want this rule or we want a different version of it, they would have to go back through the notice and comment period to do that. And sometimes when an agency or a commission wants to do something like that and it's in active litigation, they will ask for the litigation to be paused while it's going on. Sometimes the parties challenging it will agree. They'll say, that's a great idea, let's not waste resources. If they don't, usually the courts will give the agency some amount of latitude and some time to go back and think about it and figure out what they're going to do. But eventually they say, that's enough time, we got to get this moving again.
No matter what, it sounds like a lot of job security for appellate lawyers. James, I'm wondering if you could kind of speak to this issue of, we've had environmental groups file challenges to the SEC final rule. They obviously want something more stringent. What are some potential roadblocks inherent in principles of administrative law that might make that a difficult fight?
Yeah, so it's a great question. I think it dovetails with a question in the chat, which I'll start with, which is, somebody said Sierra Club and Liberty Energy, who's the filer in Fifth Circuit, they seem kind of like strange bedfellows. And is there going to be an opportunity for everybody to make their arguments? The answer to that question is yes. What we expect will happen once the cases are consolidated and wherever they're ultimately going to be litigated is that the parties will get together and create kind of a bespoke briefing schedule. So the court is not going to force Sierra Club to go on the same brief as Liberty Energy and the Chamber of Commerce. They'll each be able to file their own brief, sort of presenting their own theories of the case. I mean, you raise an interesting question about these environmental NGOs that have filed cases and what it is that they're trying to accomplish. It's difficult to know what arguments they intend to pursue because, as Corinne mentioned earlier, the actual petition for review document is a pro forma 1 to 2 page thing. We don't really know what arguments they're intending to make until we see them file a brief, which could be a year from now. But I gather from the press reports that generally their view is that the SEC did not go far enough, that perhaps Scope 3 should have been in there. I expect that what the SEC is going to say to that is, even if I had, theoretically, if that were within my statutory authority, there's nothing that obligates me to exercise that authority if I don't want to. So Sierra Club really can only succeed on this argument if they're able to show that the SEC had a statutory obligation to, for example, include Scope 3 emissions. I think that's going to be a very difficult argument for them to win. It may be the case that they have some gripes about various little things, factual problems with the record or whatever. Certainly they can present those arguments, but I personally am doubtful that they will be successful kind of pursuing this top line theory that the SEC needed to do more. It may be the case that these groups filed petitions for review just to manipulate the venue process and that they don't actually intend to sort of follow through with all of this. So as you will see, the environmental groups filed in the DC circuit, that's a case that is dominated by Democrats right now. And also in the Second Circuit, which is also a case where a court where there are more Democrats than Republicans. That is not the case in the Fifth Circuit, in the 11th Circuit, and the Eighth Circuit. The Eighth Circuit right now, there are 17 judges, of whom only one is a Democrat. And of course, you have to take all of that with a grain of salt because these are only very loose proxies. But we sort of know why people filed where they did. So I hope that's an answer to your question. I think basically the answer is we have to sort of wait and see. It could well be the case that after one of these circuits is selected, Sierra Club could potentially drop its petition for review and move to participate as an amicus, defending the parts of the rule that the challengers don't like. We just don't know. We'll have to wait and see.
This is where I will put a plug for our quarterly ESG newsletter, because from this point forward, we will probably be doing a little litigation tracker element of that where it just says, here's where we are. So that's an easy way to keep up with it, because it is going to be something that is very, very pertinent to your consideration and implementation of these rules.
And so, James, one follow-up kind of coming at it from the other angle. If I'm a registrant who thinks this rule is outside the SEC's statutory authority, are there any other kind of admin law issues happening in the background separate and apart from this? Like, we always hear about the Chevron doctrine, and we know that the federal judiciary right now is not as friendly towards the Chevron doctrine as it once was.
Right, yeah. So I think three sort of big picture things that are happening at the Supreme Court right now that may potentially prove relevant to this. The first has to do with Chevron. There are two cases pending at the Supreme Court right now called Loper Bright and Relentless, in which the petitioners are asking the Supreme Court to overrule Chevron deference completely. And the conventional wisdom here in DC is that that is reasonably likely to happen, or at least that the Supreme Court could significantly narrow Chevron deference. That may end up playing a big role in this case to the extent that the SEC is saying that it's interpreting ambiguous parts of its enabling and organic statutes, the 33 and 34 Acts. It might not, because generally Chevron deference, there are at least open questions about whether you get Chevron deference for an interpretation of your own powers or authority. It's sort of a complicated thing. Another thing that's happening at the Supreme Court right now, as Corinne mentioned, is this reinvigoration of something that's called the major questions doctrine. This is something that John Roberts and others have really developed in the last couple of years. Basically, the idea is that the Supreme Court is now saying that if an agency is claiming a big power to do something, especially something that it has never done before, and if it is saying that that power comes from kind of an old-timey statute like the 1933 and 1934 Acts, that the court's going to be pretty skeptical of that, because it assumes that if Congress wanted an agency to opine on a so-called major question, that there would be clear statutory authority for them to do that, clearer statutory authority than, at least in my view, the SEC has in this case. So that could be sort of a thorn in the SEC side as we move forward. And then the third thing is the Supreme Court in recent terms has continued to show significant interest in the so-called commercial speech cases, so kind of subcomponent of the First Amendment world about when, if at all, is appropriate to compel registrants or other commercial actors to speak in response to regulatory or statutory obligations. The Supreme Court's been very skeptical of those. We'll have to see how it comes out, but as you will have seen from Liberty's stay motion in the Fifth Circuit, they have put the First Amendment kind of front and center. So that could end up being a very big part of this litigation. The last thing I'll say is, what ends up happening on remand, if anything, is really quite dependent on which theory the Supreme Court or the Court of Appeals goes with if it decides to invalidate the rule. If they do ultimately invalidate the rule on so-called major questions doctrine grounds, I think there's an argument that the SEC can't really do anything on remand. So, we could have a long conversation about how long these agency remands usually take. Generally speaking, they're done within a year. Sometimes they can take 5 years or more. But if the court's decision just says, look, you don't have any power to regulate in the climate space, it would sort of be useless to do a remand, right? Because there's nothing that the agency can do. If, by contrast, the court says, yeah, you have the power to do this, but I don't like the record. I think you didn't respond to so-and-so's comment, or you didn't sufficiently explain why it is that you're doing X, Y, and Z. That's the kind of thing that could be fixed on remand. And in that case, I think we would expect that the SEC would devote significant resources to it, at least so long as it remains controlled by Democrats, which sort of always difficult to predict what the Senate is going to do. But I think that the general expectation is that there will be a Democratic majority on the SEC at least until 2026, unless something unpredictable happens.
Well, and to circle back to the First Amendment piece, I know, Sarah, we've talked about that's not a unique challenge to an SEC rule. We've seen it before in the conflicts minerals space. And those rules, even though they've gotten knocked down a bit in court, they're still there in some form in the end.
And that is the sort of the cautionary tale here is you've heard a lot about these court seats. It may be at the end of the day that, which I think is less probable than not here, but there's always the possibility that it does sail through and that it does, much like the conflict mineral rules did, and they ultimately are, now applicable, right? So there's always that possibility, and that's why you can't take your eye off these rules or planning for them.
Well, all right. I think Corinne, James, I'll leave you both to give us any parting thoughts, or if you've already said everything you've got to say on it, we can break early for the happy hour.
Yeah, I think that's, my key point of guidance is just, the status quo is that the rule is on pause, but don't assume that that is going to remain the case. And, keep watching the news, because it could be the case that we get an order today, tomorrow, that lifts the stay. This is a very live situation. And I think everybody would be well advised to keep an eye on the litigation piece of this in the coming weeks.
All right. Well, thank you, everyone.
All right. Thank you, guys.